the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. While Singapore shares rose today as investors continue to monitor global developments relating to trade. Now, the Straits Times Index was up 0.8% to 3,967 points at about 12:50 p.m. Singapore time, with a value turnover of 654 million Sing dollars in the broader market. Now let's take you through the closing numbers. The STI was up 0.46% at 3,954 points. And in terms of value turnover, we are looking at 1.43 billion Sing dollars. Now, gainers trailed losers, 220 versus 280. Top advances for the day we've got for you DBS, SGX, and Prudential USD. And top decliners we have here GMH USD, Venture Core, and New Incorporation USD. Well, in terms of counters to watch, we have ESR REIT after the trust's manager completed the divestment of a logistics property in Singapore for 6.8 million Sing dollars. That's also as investors continue to set their sights on DFI Retail Group after the supermarket and retail store operator yesterday announced the divestment of its Singapore food business to Macrovalue Malaysia at an initial purchase price of 125 million Sing dollars. Now, meanwhile, from Asian investors' reaction to Xiaomi's $5.5 billion US dollar mega share sale and Hyundai's $21 billion USD investment in the US to the Indonesian rupiah falling to the lowest since the Asian financial crisis, we've got more international and corporate headlines in focus. And joining me on the line today is Carmen Lee, head of OCBC Investment Research. Carmen, welcome.
Thank you.
How are you?
Great.
And Carmen, let's take a look at whether the stock market is feeling good or not, okay? How did the STI fare today, given how busy it is as a week for investors? And any surprises when it comes down to ESR REIT after the divestment of a logistics property in Singapore?
Okay, if you look at the market today, it has gone up quite well, up about close to 0.4%. And this is in light of the fact that some of the regional markets were down. In fact, if you look at the Hong Kong market, it was down quite significantly as well. And if you take a look at some of the REITs in particular, actually REITs have actually done very interestingly quite well. From the low recently in early March of about 7 March, when the REITs was at its low, it has actually recovered close to 4.9%. So you've actually seen that REITs have recovered from the recent low, and similarly banks took a hit and then obviously reversed that. So it has somehow or other emerged as a very interesting trend within the Singapore market that both REITs and banks are now seen as opposite play. So there are days when REITs are up and there are days when banks are up. But again, that's because of the fact that both give you now about close to 6% in terms of the dividend yield. So there's actually been switches. I mean, you can see investors switching in and out of a position either within the bank or within the REITs. And so on days when the banks are doing well, you tend to see that actually some of the REITs would have underperformed as well. So like I said, this is viewed as more like alternative sort of products. But overall, having said that, I think that if you look at the Singapore market overall, then you can see that actually the banks have actually done very well this round. And don't forget the fact that a lot of them will be giving out very good crop of dividend in the next 1 to 2 months. So that's something we look forward to in the coming 2 months or so.
And zooming in on some of the counters that we continue to track, Carmen, we have here DFI Retail Group. Now, yesterday we've seen news of how the supermarket and retail store operator announced the divestment of its Singapore food business to Macrovalue Malaysia at an initial purchase price of 125 million Sing dollars. Now, Macrovalue has since said that customers of Cold Storage and Giant, they can now expect more value for money, a greater variety of merchandise and new outlets following the sale. Any thoughts on the matter? And broadly speaking, what is the outlook for DFI Retail Group then, post the divestments, given how they are now focusing on Guardian and 7-Eleven?
Yeah, I think Macrovalue Group is, of course, a Malaysian group. And if you look at their recent strategy, it has actually largely been focused very much on the retail supermarket chain business in South Asia. So if you take a look at it, they recently also acquired in Malaysia the operation. And so with this whole retail operation within Malaysia and then now looking into Singapore, Obviously, there is going to be quite a fair bit of synergy, both in terms of sourcing of products, as well as also economy of scales in terms of their operation. And I think in that sense, it will also benefit consumer because of the fact that they now get a wider range of products and services, and perhaps a much easier flow of trades in goods and services between Malaysia and Singapore as well. So I think this really fits in very nicely within their strategy as well for the whole supermarket business. Having said that, you do know that the supermarket business is fairly defensive, and similarly for Singapore's market, I think we tend to do very well as a defensive sort of market. So in this era where we are seeing quite a fair bit of volatility, especially like we shared earlier about trade tension and the whole US-China tension as well. So yeah, you definitely will take a look at some of the more defensive counters, and if you take a look at that, then obviously the supermarket segment is actually a fairly defensive sort of sector. And overall, I think this seems to quite complement what they are already doing as a company, which is, of course, acquisition of businesses by growing by acquisition, actually, because of the fact that they already acquired one in 2022, and then now 2025 they're acquiring the Singapore operations as well.
Okay. Now, Carmen, in the meantime, we continue to track equities with exposure to the Indonesian market. This, of course, as the Indonesian rupiah declined to its weakest level since the Asian financial crisis, fears mounting over the nation's fiscal trajectory. Broadly speaking, what do you think the movements with the rupiah would have on SGX-listed counters with exposure to the Indonesian economy?
Yeah, we've taken a look at this, and there's only really a very small handful of companies with exposure to the Indonesian business, less than 2 dozen. And of this, only 1 or 2 are very big cap companies, and the rest are actually in the more small to mid cap space. These are really not very well researched and also not very well traded, largely due to the fact that they are very small in terms of the whole market capitalization. And so if you take a look at the year-to-date price change, actually it ranges between minus 33% to positive 53%. So it goes to show that actually the range of price movement is quite large. Largely also because of the fact that I think some of these are really sector-specific sort of price movement rather than just the rupiah alone. So overall, I would say that the impact is fairly minimal and quite well balanced by the fact that most of these companies do have businesses outside of Indonesia as well. So they do derive their earnings from other countries. And that, in a sense, helps to offset the impact of their rupiah revenue. Again, overall, very small in its impact, and also very small for the Singapore market as well.
If you're just tuning in, we're now in conversation with Carmen Lee, head of OCBC Investment Research. Well, across the region, Carmen, Asian equities mostly up today amid easing fears of a US President Donald Trump's planned reciprocal tariffs. So it could be more narrow in terms of the scope. But Trump also said he would announce tariffs on automobile imports in the coming days. So what do you think that could mean for investors?
Okay, one thing for certain, I think volatility, and the market generally dislikes volatility. And with Trump, it has become a bit more erratic in terms of how do we forecast and do the projections as well. And because of this whole rapid changes in terms of the trade policies and tariff, and as you have shared earlier on, he's not intending to announce earlier than expected, because earlier on it was scheduled for the 2nd of April, where the market is already expecting a suite of tariffs to come out on that day. But now it seems that some of these tariffs could come in sooner than expected. So with this, I think what is very certain is, of course, the fact that the market just cannot adjust in time for some of these changes as well. And also this, in a sense, reflects market sentiment and discomfort with uncertainty, especially towards government policy. I mean, we have to bear in mind that businesses do want certain clarity, especially in terms of tax policy, so that they can drive their future investment, especially for very capital-intensive industry or for companies with very global operation trying to do trades or do businesses. And so a large part of this whole uncertainty has actually, in a sense, impacted the stock market. And so if you take a look at this, what is very clear is that since Trump's inauguration on the 20th of January this year, key U.S. indices have actually declined. So if you take a look at S&P 500, it's down almost close to 4% so far this year already. So again, this reflects the underlying uncertainty that investors as well as companies are feeling towards some of these tariffs and what is the potential repercussion on their businesses. But meanwhile, if you take a look at what's happening over in China, year to date from 20th June to now, actually Chinese stocks have done very well. Up almost, if you look at the MSCI World China Index itself, it's up almost close to 20%. So again, this tells you that because of the fact that policy in China now is a little bit more certain, so funds have actually, in a sense, shifted some of their attention. So So basically, with this uncertainty with Trump and his trade policy and tariffs, that has created generally a very volatile environment, and as a result of which some investors have taken their funds out of some of the US stocks, especially stocks that have done very well in the last 4 years or so, and then I guess they're looking for other places, and in that sense, it has benefited some of the other regions. So.
Kaman, the reason why I'm asking about Trump's tariffs is because we are seeing some companies investing in EVs, which, ties in with the automobiles, possible automobile tariffs. And at the same time, Trump is encouraging investments into the U.S. We're also seeing some companies making investments in the U.S. So if I could bring in some more context, right? If we look at Chinese tech giant Xiaomi, it sank almost 5% earlier today after it raised $5.5 billion USD in a mega share sale to expand its electric vehicle business. I don't think we know if it involves investing in the U.S. or China, but automobile tariffs would be of concern. Now, at the same time, if we set our sights on Hyundai, it saw shares surge around 6% on the back of a $21 billion USD US investment. Question, though, the bigger question perhaps, do you think there will be a divergence in outlook for automobile companies or for companies investing in the US versus those that don't in the longer term given the possible tariffs? And is U.S. consumption that significant if we look at the size of the world's population?
Yep, I think as you already pointed out, I think Hyundai's investment is actually in the U.S. itself. So that kind of make a difference in that. I think you're going to create new jobs in the U.S. market. And also, perhaps if you are producing out from the U.S., then in terms of the tariff environment, it's not so much of a concern, which perhaps explains why it has actually, in a sense, gained this today. On the flip side, of course, if you look at Xiaomi, I think there are more than one factors. I'm considering 5 to 6% decline today, apart from the fact that the general market sentiment in Hong Kong has actually come off today, and which is also reflected in the Hang Seng Index, which is down. I think there are some of these more company-specific sort of factors impacting the stock. But do bear in mind, especially for Xiaomi, it's actually outperformed very strongly this year. I mean, year to date, in fact, it's one of the most outstanding stocks. It's up almost close to 55%. So again, when the market has weakened somewhat today, I think it's only right that some investors have decided to take profit as well. So part of the decline, I would say, is largely due to the fact that the stock has truly outperformed, and investors are just taking some money off the table. So,
Don't mind me asking this question, Carmen. I just want to get your take on this as well. Some analysts on the show have said that, companies like Xiaomi, even if we are seeing tariffs from the US, they could still sell to the rest of the world. We look at the world population versus the population in the US. What are your thoughts?
Yep. I think that fortunately, a lot of the companies, because don't forget that this is Trump's second term, right? So let's call it Trump version 2, right? The thing is that a lot of the Chinese companies, and even the Chinese government policy, they are quite prepared for it this time versus the first round when it was still a lot. I think a lot of companies and even government policies and decision makers were caught off guard the first time around. But this round, I think most companies are, in a sense, quite well prepared. And actually, the other thing is that, of course, if you look at this round in terms of what Trump has said, he's targeting quite a few countries, right? So, in fact, some of the tariffs are even higher in certain countries. So, if in general, every country is going to see some form of tariffs, in comparison, it isn't going to be so bad for a Chinese company, right? I mean, you're going to impose 20% on perhaps, let's say, Mexico, and then 20% on Canada. And if it's 10% on China, then obviously relatively is a lot. It's only when your country is being levied the tariffs alone, then that could possibly have a more significant sort of impact. But overall, I would say that this round, I can sense that more companies are more prepared for this versus the first time. And so as a result, which while there could possibly be tariffs ultimately when it's announced, the impact perhaps is a lot more well absorbed by the market.
Okay, and finally, before we let you go, Carmen, let's take some time with this one. Alibaba Group Holdings chairman Zhou Tai, he warned of a potential bubble forming in the data center construction space, arguing that the pace of the build-up of data centers could outstrip initial demand for AI services. What are your thoughts on the matter? And if we're truly seeing a bubble here, what do you think are the implications on the global tech sector, and how concerned should we be about this?
For the longer term, as a house, we're still very positive on the AI trend, and we still see this as a mega long-term trend. However, having said that, because AI is still, to me, at a very infancy stage, there are going to be a lot more exciting and interesting developments into robotics, into so many other areas, right? So during this whole phase of investment and trying to create more products and services that will leverage on it, there will be some mismatch. especially in terms of infrastructure investment and construction. So I think what happens now is the fact that the data centers are actually expanding, but perhaps the take-up is a lot slower than expected. But again, data center takes time, money, effort to build. So there could possibly be some mismatch in terms of demand and timing as well too. But over time, hopefully all these mismatches will iron out, because as the industry grows exponentially, then that will be when they can possibly iron out. But now, because as he rightly said, this is just the initial part. So the initial demand obviously is not going to match in a very parallel form, right? So that's why I think there's a bit of that mismatch looking on. But if you can just look back into history, perhaps even take a look at some of the technology stocks, for example, like Apple. Apple has historically traded between 10 to 40 times. And then on average, you take a look at it, it's almost close to 21 times earnings, right? So valuations for technology stock, because they're really high growth companies, are usually at the high end of the spectrum. I mean, the market is generally trading at 10 times, and technology stocks will trade with above that, right? Higher than average sort of thing. So while I think the current view is that tech stocks are so expensive, so a bubble is likely to happen. If you look back into history, again, like I said, I think most of the technology companies are always trading above the average market industry average anyway. So whether if a bubble is forming or not, I do not think so. But obviously, when it goes high, there are more opportunities to do some profit taking, and especially in this environment whereby policy changes are so uncertain. So you can see funds and even investors taking some profits of their position. But overall, I would still say that the trend remains quite intact. There will be short-term volatility in terms of the movements and prices. But having said that, the longer uptrend is actually still fairly intact. But as we always like to tell clients, I mean, this may sound a bit cliche, but we still like the high growth sector. But having said that, it's always prudent not to have an over concentration. And I think a lot of people tend to like a lot of technology stocks, but rather hold a more diversified portfolio of maybe growth as well as value stocks. Because I think this environment where there's a lot of uncertainty, you want certain value stocks just to balance out the portfolio as well.
I see, lots to watch indeed. That was Carmen Lee, Head of OCBC Investment Research. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.